Hey guys, how are you? Unmute all. Okay, we're going to be starting off in about 4 minutes. So, yeah, I'm just going to get ready here. I'll kick it off a little after 7 in 4 minutes time. Okay. All right, I'm just going to grab a drink of water. I'll be back in a minute. All right, we'll kick it off in about 2 minutes. So let me just get myself organized. Okay, work out how I'm doing this. All right, let me share my screen and I'll get going in 20 seconds. All right. All right, now can everyone see my screen? Great. All right, so you can obviously hear me. Awesome. So let me check that the time is right. And all right. So let me start on today's webinar. I'm on a laptop here, so yeah, I'm on a laptop here, so it's a little clunky for me. So let's talk about the Holy Grail scalping system. And today I want to go into detail about the trend following aspect of the system and how we switch it on and how we switch it off, because it's by far the most difficult aspect of the trading system, and it's the one that people need the most help with. So the Holy Grail system has, let me just check the chat. Everyone, okay, so everyone's good. So the Holy Grail system has two components. About 75% of your trades are mean reversion trades, while only 25% of them are trend following trades. Now, the mean reversion aspect of the system is drastically, and I mean drastically, easier to learn. And because of that, many people learn it first, and often they neglect the trend following aspect of the system. And that's a huge mistake. And why is it a mistake? It's a huge mistake because the trend following days are generally drawdown days for mean reversion systems. And what I mean by that is if you're trading mean reversion, betting against the trend, and you get a trend day, a trend that just goes and goes and goes and goes all day, then you probably paint loser after loser after loser after loser on those days, right? So if you're trading trend following and you get a trend day, you're probably going to do pretty well. If you're trading mean reversion, you get a choppy day, you're probably going to do pretty well. That's just logical. But there's a problem in that on trend days, a lot of trades get taken. So for a normal mean reversion system, you might take 3 or 4 trades a day on a normal choppy average day, and on a trend day, you might take 7 or 8 trends. So what that means is that your trend days really, really suck disproportionately in your results when you trade only mean reversion. Now, another reason why neglecting trend following is a huge mistake is that trend following performs much better than mean reversion in this system anyway. Generally it doesn't, but in this system it does. The win rate is higher and the expectancy is higher. So trend following days are generally drawdown days in mean reversion systems. So this is the last 40 trading days, and you can see that all of the biggest days here, all of the days that really contribute disproportionately to your profits, come from these trend days. So your best days are going to come from taking setups in the direction of the trend on a trend day, because on those days you might take 7 or 8 setups in the direction of the trend and win 6 of them. Now, this is the absolute key to super performance and the super performance of the system. So if you can imagine how this same graph would look if instead of these big wins, you had big losers on these days, you had 4 big loser days down like this whole system performance would be completely undermined. It would still be an edge, but it would be an average, mediocre edge. It would be nothing to get excited about. It would be just another crappy mean reversion system. Right? So here is the performance. This is the real world performance of trend following setups versus mean reversion setups. So the win rate, 68.75 compared to 62.5. The total R is 60.3 compared to roughly 20. So this is 75% and 25%. But the expectancy per trade, look at the difference. This one performs at 0.6 expectancy. Mean reversion performs at 0.37 expectancy. So the 0.6 expectancy is just a huge bonus. It's better than you have any right to expect. Now, there's an even bigger advantage to trading trend following as well. By not taking counter trend setups when we're in our strong trends, not only do we get these trend following setups, which we've just seen are much higher expectancy, much more reliable, just better in every way. But also we don't take the mean reversion setups that suck on the days that they're gonna suck. So you get a double whammy effect. So we make our drawdowns shorter. We remove the possibility of continuously losing by betting on trend reversal, and we drastically, and I mean drastically, lower the possibility of having, a blowout, terrible down 10R day. And I want you to look at what this does to drawdowns. See many drawdowns here? Like this is your biggest drawdown, second biggest drawdown. Like really, fuck drawdowns. Like no one wants to be in drawdown. And beginner traders tend to be focused on how much is the total money they're making. That's the wrong approach. So we could rejig this system to probably have this equity curve up here, but make it go like all over the place and end up here. That would be a mistake in my view. I am very focused on this being a system that is profitable for 4 out of 5 trading days, which it is, actually 78%, so nearly that. And we're very focused on having low drawdowns, because low drawdowns are what makes a system easy to live with. You know, it's like when you see that hot stripper and you think that would be great to date her, but she's hard to live with. Like, she's a pain in the ass. You know, this is your wife material system. You know, this is the one that it's just steady and smooth and reliable, and you can bank on it. This is the type of equity curve that you want to design your systems to have. Now, let's look at the ES equity curve, which has, you know, a lot more data in it, and it's not quite as smooth because of the distortion effect of the open and close of the market, but you can still see that there's very low drawdowns. We've still got very low drawdowns, very low drawdowns. Now, if you've tried to implement this system in your own trading and you haven't been able to replicate my results, if your results are falling short of my results or Daniel's results, almost certainly a couple of things are going wrong. And the big thing that you're probably neglecting is trend following. If you're neglecting this and thinking, oh, it's just too hard, or I'll just do the easy bit, massive mistake. So you're going to have bigger and longer drawdowns than me. You're going to have a lower average win rate. You're going to have less consistency. You're going to have more losing days. And those losing days are going to be worse for you than they are for me. So there's a double whammy effect, and the double whammy effect is huge. So what we're doing is two things. Both of them have an impact on your trader performance. Thing number one is we're skipping mean reversion trades in your worst drawdown times. So those terrible days when you just don't want to be betting against the trend, we're not betting against the trend. Second thing that we're doing is that when betting against the trend is a stupid idea, not only do we not bet against the trend, we bet with the trend. Double whammy, bam. So what's the catch? And there's always a catch. Nothing for free in finance. There's very few free lunches. So the catch is that trend following setups account for 25% of the total setups, but they only happen in about 12% of the total price action. This means is that they're very, very rare. You can go 3 or 4 days without seeing a trend following setup. And so what happens is that it makes it difficult because you get complacent and stop looking for them, and then bam, you know, you get smacked in the head and you miss them, and then you've missed out. So you need rules to help you. And what we're going to do today is I'm going to explain exactly the rules of applying this in your own trading so that it's black and white, so that there's absolutely no difference between the trades that you take and the trades that I take. Because as far as I'm concerned, if there's any way for your rules and my rules, us to both apply the rules and get a different result, then it's not a real system. So once low volatility trend mode is on, we call this low volatility trend mode, and once it's on, we switch it on, and what do? We stop taking counter trend trades. So you can still take mean reversion trades, but just in the direction of the trend. And then we start looking for trend following trades. Now, the decreasing volatility trending rules. These are the rules. This is what you need to know. You need two things. Thing one, you need a confirmed trend, and we're going to cover this in a minute. Thing two, which is the real heart of it, you need a new closing high for the trend if it's a bullish trend, or a closing low for the trend if it's a bear trend, for the trend while making a lower ATR in the most recent bar. So what you're looking for, and I'll explain this, I'll show you a bunch of examples, don't worry yet. You're looking for one single bar, just one bar of a new closing high with a decreased ATR. Okay, now once this mode is activated, it stays on until it's off. And there's 3 ways to turn it off. I'm going to be covering those later. So let's go through that again. 2 things. Thing 1, confirmed trend. Thing 2, new trend high or low, closing high or low, with the single bar decrease in ATR, and the parameter is 14, it's ATR 14, which is the standard one. Okay, so before we start, I want to point out that the vast majority of trends have a volatility profile like this. This is a normal trend. In a normal trend, you can see that we might want to bet against this, we might want to bet against this, we might want to bet against this. Betting against the trend is totally fine in a normal trend, right? What we're looking for is an abnormal trend. the vast majority of trends increase in volatility. We're looking for that very rare trend that decreases in volatility while it goes up. So, easy way to recognize a confirmed trend. The easiest situation is where we have a trading range and we have the first close above the high of that trading range. So you can see here we have a trading range. We have it touching the trading range, but you can't be sure at this point that it's not going to go down. The point where we can be reasonably sure that a trend is on is this bar right here. This is the easiest situation where we've got a break out of the trading range. The close above the trading range high is here. Now, this doesn't matter as much as you think it does, and I'll be covering why shortly. So sometimes a trend is just like a textbook, super smooth, perfect one. This is about 1 in 9 trends look as beautiful as this. Now, where is the point where the trend starts? You can never be certain that a trend is going to start in the first leg. A trend has to go past the first leg and the first pullback. So when can we be sure that the trend is on? Probably here or here. And then it continues. But one thing I want to point out to you is that in these strong and smooth trends, nearly always they're increasing in volatility. So they're not what we're looking for. Sometimes it's easy. You know, in a super smooth trend, you can recognize it early and you want to get on board with it. So let's do a little exercise. I want you all at home to tell me where you think the trend starts. Does it start here? Does it start here? Does it start here? Does it start here? Where do you think it starts? I just want you to pick a bar in your own hands. In my view, this is the bar where the trend is confirmed. Why? Because we have the first close above the old high. This is the bar that the trend starts. Now, let's go through some more examples. And one thing I want to point out is that you might be thinking that where the trend starts is a little subjective. And ordinarily I'd agree, but consider this, it doesn't really matter much, and I'll explain why in a moment. And it's going to become very, very clear to it. So no matter what you think, as long as you're anywhere in the ballpark, you're going to get exactly the right result. So let's look at this one. So where does the trend start? Where can we be sure that we're not just going to go back up here and we're actually going down? What do you think? Okay, I think the trend starts here. I think that's when it's confirmed, but you might say that the trend started here. At all, what you think is that always at the start of a trend, volatility is rising. And we're waiting until volatility decreases. So if you think the trend started here or here or here, those things are of very little import, because what we need is to wait for the trend to make a new closing low with a bar-to-bar decrease in volatility. And that happens in this bar. You can see that from here down to here. It's very subtle, just one bar. At the same time as we make a new closing low for the trend. This was the previous close. This was the previous lowest close for the trend, but this one happened on an uptick here. This bar happened on an uptick. This bar happened on a downtick. And I want everyone to be really clear for that. We want a single bar downtick with a new closing low for the trend. This is what we need. We need a confirmed trend that happens here. And we need 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 bars later, we need a new trend closing low with decreasing ATR. Boom. At this point here, after the close of this bar, we stop taking mean reversion setups. So we stop taking long setups and we only take short setups. So later on, we take this short setup here. Now I've zoomed in a little bit so you can see that. You can see that as the bar, as price makes a new closing low here, we've gone up from here to here. So that doesn't fit the criteria. But as we go down from here to here, making a new closing low, we've also gone down in ATR. Boom, that's it. And so what happens is you can see this long setup here, significant high, low, higher close, lower close, setup complete. We would ordinarily have gone long here, but we skipped that one. So we're skipping that losing trade. Now, I'm going to go through some recent examples of trends. I'm going to take some questions, and I want you to remember that this is only a system if every single one of you gets the same answer to the question, when does decreasing volatility turn on? So if you and I can go through our thought process and get a different result, it's not a system, it's just bullshit. So I want you to keep in mind that you should be getting exactly the same result as me, or we got a problem. All right, and I'm gonna go through some examples, and I'm gonna load up some live charts afterwards, and I'm gonna take some questions, and we're gonna go through. So before we go through that, when does decreasing volatility switch off? 3 ways. So once it's on until it switches off. It switches off, 1, with new ATR highs. Number 2, switches off with the historical low in ATR, followed by a spike in ATR. And historical low is reference to the current session low. So I'll cover some examples of this. And the third way, which is the rarest and most difficult, is a break in the pattern of lower highs and lower lows in ATR. And I'm going to cover that shortly. Okay, so you can see here, where does this become a confirmed trend? It becomes a confirmed trend here. But ATR is still rising. We need to wait until we get a new closing high we get a new closing high here, but if you look closely, it's on an uptick. Here, we get a new closing high, but it's also on an uptick. This bar here is a closing high and a downtick. So we stop taking short setups right here. Now, very soon after that, you can see here, this was the old ATR highs. This is the new ATR highs. We've broken out to fresh ATR highs, and we switch back on short setups. Now, even though we didn't get a short setup, if we did get a short setup here, you really wanted to take that short setup, right? Because it worked. So this is the rationale behind switching it off and then switching it back on. And it doesn't matter how many times you switch it on and off, the rules are black and white. So here we see another example. When does this become a confirmed trend? About here. But it doesn't start decreasing in volatility with a new closing high until right here. And then you can see it makes new ATR highs here and switches back off. Okay, and it's worth noting that decreasing volatility mode may switch on and off several times during the course of a long running trend. That's just totally normal. So you can see here, when does it become a trend? Becomes a trend here, switches on here with a single bar decrease. So we stop taking long setups, which is good because you wouldn't want to go long here with a stop loss here. You get stopped out. You wouldn't want to go long here with a stop loss here. You'd get stopped out. You wouldn't want to go long here with a stop loss here because you'd be stopped out. So what I want to be very clear about is by switching on, we've saved ourselves 3 losers in the space of 2 hours that we just didn't get to take. And then it switches back on, and now we're free to take trades again. And then you would take this one long at the right time. Okay, now the third and final, the last way of turning back on is to break the pattern of lower highs and lower lows. So in a trend, it's normal for ATR to go up and down, but it's going to be like a downtrend in ATR. So here you can see we've made a lower low, lower high, lower low, lower high. And if we break that pattern of lower highs and lower lows, like we have right here, now all of this time we're not taking long setups. Why aren't we taking long setups? Because you don't want to go long here with a stop loss here. You'd be stopped out. You don't want to go long here with a stop loss here. You'd be stopped out. You don't want to go long here with a stop loss here. You'd be stopped out. And you don't want to go. No, that's it. But can you see that we've saved ourselves many losing trades? We've saved ourselves a losing trade here. We've saved ourselves a losing trade here. We've saved ourselves a losing trade here. we just don't want to take those trades. Skipping a losing trade is as good as taking a winning trade. Now you can see here, as soon as we break the previous high peak in ATR right here, now we do want to take long trades. And once you switch back on and say, okay, I definitely want to get long here, stop loss here, look at what happened. It actually makes sense to do that again. Now, this is the rarest of situations. It's very infrequent. It doesn't happen very often, but you have to be aware of it. Okay, so at this point, I'm going to take some questions. Okay, so let me go to the attendees, and sorry, I'm a bit clunky on this. Questions, can you just add in the chat? Questions answer. Okay, anyone who's got questions, either add them in the chat box or in the Q&A. No questions? Any questions? No questions. Can someone just type something so I know that you know you're okay? All right. Black Arb CEO. There we go. Okay, I've unmuted you, man. Talk away. Hey, Chris.
How about now?
I can hear you, man.
All right. I had a quick question about when you were talking about the new ATR highs within the trend.
Yep.
The example you showed, it looked like there was another bar that was lower in the downtrend. So how would you determine when it's a new ATR low or high relative to the other bars?
Let me load it up. And I'll share it again. Okay. Okay. Let me just share my screen again. Sorry, this is a bit clunky on a laptop. Okay. This was the example that I showed, right?
I think it was the one where you went short.
Okay. New ATR highs. Okay, this one here. Can you see that?
It was a new ATR low.
A new ATR low.
Or no, yeah. It was to go short. Yeah, that might be it.
Okay, this one is it. Okay, you can see that this is the previous for the trend. So we look at the whole trend to date. What is the highest ATR level for the trend once it started? Clearly it's here, right? You got that?
Right.
Now, once ATR passes that level here, you can see it happens on this bar here. So once ATR passes that level, then you switch off trend mode again and you start taking shorts and longs again. Clear?
Okay. Can you go back to when trend mode turns on? I think that's what I'm looking for.
Okay, so it turns on when we have two things. Thing one is a confirmed trend, which happens in this bar. Why does it happen in this bar? Because we have our first close above the previous range highs. So it turns on here, but you can see here it happens with an increase in ATR, which is absolutely normal almost every time. So what we're looking for is a new closing high. So it has to close above the close here, which happens here, but it closes on an uptick. You need this bar, go from this bar to this bar with a downtick. Now that happens here. Now let me zoom in so you can see it easier. So it's easy to see in this example. So you can see here we have a new closing low for the trend, but it happened on an uptick. Like from this bar to this point, it happened on an uptick. We need that to happen on a downtick. And here, this bar is the first time we get a new trend closing low. So a new closing low close below the close and a downtick in ATR.
So when you say closing low, compared to which bar are you comparing that to?
To the lowest close for any of these bars once we started trending. So we started trending here. This is the lowest close. This close isn't lower than that. This close is now the lowest close for the trend, and so it has to. So this close has to be lower than this close. So the lowest close.
So do we ignore those two hammer candles?
Do they close at the lowest? Do they close at the lowest point for the trend? It's a black and white yes or no question.
Oh, I see what you're saying. Okay, because I'm looking at the low, not the close.
You look at the close, not the low, and that's critical because and why is that? Let's talk about that. This could, if you get a hammer candle, it could easily bounce, right? Like a hammer candle often precedes a bounce. We can't be sure. When we can be sure is when we've got a close below here with no bounce. If this market was going to rally, it's going to rally probably about here, right?
Right.
This is the point where the market's tipped its hand. The market has opened up and said, I'm not going to fucking rally here. I know you thought I was going to rally. I'm not. We're going down. And so at this point, we look for a single bar decrease in ATR. So you only need one bar.
Okay. Now it makes more sense.
Okay, I've got a question here from David. What time frame do we determine lower volatility, 2, 5, or 10? And the answer is 2-minute only. We don't pay any attention to the 5 or 10. We want to keep this simple, and we want to keep it objective, and we want to keep it black and white. Okay, let's take some more questions. The trend definition is the first bar that you can exclude the possibility that we are not in a trend. And what I've covered is that it doesn't really matter much where you think that is. As long as you get it within 5 or 10 bars, you'll be fine, because we also need a single bar decrease in ATR with a new closing high or low for the trend. So it doesn't matter if you define a trend a little different than someone else. Any reasonable definition of trend is going to be okay. But I personally don't think it matters. Okay, got a question from Evgeny. Can you go back over the chart where you said that it doesn't matter where the trend starts exactly? It seems to me that the trend started 10 bars earlier. Let's go back over that one. Let me share the screen again. Okay, pull that down. Okay, so a trend can never start in a single. If we're talking about a downtrend that starts after an uptrend, a trend you can never be certain that you're in a trend here, because a two-legged pullback is totally normal in a trend. This is not a point where a downtrend starts, because what would be totally normal is for this to bounce and just keep going up. We need to exclude that possibility. Now, that possibility arguably happens on this bar and arguably happens on this bar. Now, it doesn't matter which of those two you think happens, because low volatility trending mode doesn't switch on until all the way down in this bar. Let me stop the share again. And okay, did that answer your question, Evgeny? Okay, Richard. Hey, Richard, how are you, man? For trends, are you still going to fix profit target or letting the trend run? No, we're still doing exactly the same profit target, and there's two reasons for that. The first reason is that in a trend day, you'll likely get setup after setup after setup after setup. It's easy to bank 3 or 4 quick 1.1R wins and just add a lot to your profit for the day. It's much easier than trying to work out how long a trend is going to run and accepting, a lower win rate. We wanted to really keep this system high win rate, and the only way to guarantee a high win rate is to take targets that you're going to get almost every time. So there's no magic. There's no magic to it. Okay, Donnie, can the Holy Grail system be adapted, used for swing trading, 4 hour and daily? I don't know. I would expect so, but many times I've tried things and had them not work. The only way to know, and you shouldn't ever believe me or anyone else about any trading, you should use my work as a basis to just pull your thumb out and do your own work, and let the evidence show what the evidence shows. So the answer is I think so, but I haven't tested. Okay, Black Arb CEO, what's the look back to determine a new price high or range back? Good question. So let me look at some charts. So everyone always wants these rules to be defined as like a highest high in X number of bars. But really the easiest way to decide if something's in a trend is to look. You know, if just take a good look at a decent chunk of the price section, doesn't have to be too much. You know, and in almost every time, because the situations are radically different, if you try and apply a one-size-fits-all rule, like the highest high in 20 bars or highest high in 40 bars, or you know, that will work some of the time. That might even work most of the time, but it's not going to have a degree of precision that you want. Now, you know, I've unmuted you too, Black Ops. So most humans can recognize things with much more precision than you can easily algorithmically define things. So if you were seeking to automate this, you would be looking at something. I would probably take a look back of about 30 or 40 bars. Spike highs for 30 or 40 bars might be appropriate, but I haven't done that. I believe that I can just look at that and go, when does it become a trend? It becomes a trend right here, man. It's fucking obvious every time. That if we look at any other trend, so when does this become a trend? It doesn't really ever become a trend, because it's probably going to be stop up here and reverse, which is, you know, it's not really a trend. You know, when does this one become a trend? It hasn't become a trend. You know, trending is not the normal. When does this one become a trend? Right here. When does this one become a trend? Probably here. Definitely here, but probably here. So it's much easier for us to recognize when things start and when things stop. You know, if we're looking at here, the first close above here is here. So if you're seeking to automate this, you would want to come up with some sort of algorithmic definition, and you would want to test a whole bunch of different things. Now, I can tell you from experience that algorithmically determining what is and isn't a trend sucks ass. Really sucks ass. It's a very unsatisfying exercise that took 6 months of my life up once and was still an abject failure. So, yeah, so that's my experience on that. Okay, good. Evgeny's questions answer. On hammer candle shooting star entries, how long or how many bars should an order remain open? Excellent question, Black Ops. And the answer is 1 bar unless it's a double top, in which case leave order open. Excellent question, by the way. I should have covered that. Richard's question is, if you were adapting this to swing trading as an example, how did you decide on the 2, 5, and 10 minute time frames? And the answer is, like most of my trading ideas, I copied someone smarter than me. And the person who's smarter than me is my student Peter, who was getting outstanding, and I mean outstanding real world results and outstanding backtest results over a 1700 trade backtest with something very similar to our rules. I believe my rules are a little bit more concise, but it's the same basic deal as Peter's system, and really all credit for the system ought to go to Peter. So Peter Vanderos, if you're listening, thank you, man. I really appreciate it. It's been really cool. Okay. Patrick, can you show the off rules again? I'll send you the recording, man, so you can see it. But the off rules are three things. Thing number one is you make a new ATR high for the trend. That is the most common situation. Thing number two is you make a low in ATR for the session and then post a spike in ATR. Thing number three is you break the pattern of lower highs and lower lows in ATR by posting a higher high in ATR. Okay, I think that's all the questions. I'm gonna keep going with the presentation at this point. Okay, so many of you have been working on this system for a long time, and I have to say that the number of traders who have been able to successfully implement this without help have been vanishingly low, and plenty of people are in a situation which is garbage in, garbage out, where you're not recognizing every single setup and you're not accurately identifying which setups to take and which setups to skip. And because of that, your results are divergent from mine, and you're not trading a system because you're not doing exactly the same as me, or you're trading a subset of the system. Is the most common mistake by far, is deciding, oh, this, I can easily recognize retest variations with a Bollinger touch on the 2, 5, and 10, and that's all I'm going to do. Now, I'm here to tell you that that is an edge, but it's a shitty edge. It's an average edge. It's a mediocre edge. It's a meh. It's like, yeah, you could do that, but you are not ever going to approach anything which I would call super performance. And I'm just being honest about that. And it was my mistake, actually, because in the original documentation, I called those particular setups the gold standard setups. I never should have done that. And it's my bad. And I apologize for that, because what it did is it encouraged people to just do that and stop. And by just doing that and stopped, their drawdowns were bigger than me. They have big losing days. They have everything that you don't see when you trade the full system, and so the results don't match mine. So what I'm going to propose is a simple test, and what I'm going to do is a 5-day challenge. So starting on Monday, what I'm going to do is I'm going to send you out images in an email of price action in a resolution that you can read, and I want you to just to mark down which setups you saw, and then I'm going to send you another email later in the day with the answer code, so you can see over 5 days how many of these things you're going to get right. So you might, if I take 3 setups and you take 4, or I take 5 setups and you take 2, then one of us is going to be wrong, right? So you're going to get an email every day with the day's price action. You're going to mark down the setups that you see, and later that day you get a second email with the correct setups that marked. Now, at the end of the 5 days, your performance is a number, and it's not a story. Like everyone I've ever asked about their trading performance, oh, I'm doing great, I'm doing whatever, it's okay, but your performance. One of the things that Laurent taught me is that your performance is a number, it's not a story. This is a very unforgiving business. Either you're good enough or you're not. Either you suck or you rock. And in the words of Nino Brown, money talks and bullshit runs a marathon. And so we have an objective measure as to whether or not you're good enough. So if you can match the baseline trades, then you're ready for the next stage. So the next stage is twofold, is building your execution skills so you can actually get these orders entered on a 2-minute chart in real time, which is difficult. I'm not telling you it's going to be easy, but it's doable. and doing a large scale backtest so that you're certain you're dealing with an edge. You cannot trust me. You absolutely must do a large scale backtest of your own. So until you can match the baseline, until you can recognize these setups perfectly every single time, you're not ready for the next stage. You're in a garbage out, garbage in situation. Your results are going to be, if you're feeding garbage into the machine, you're going to get garbage out. So what is a passing grade? And Van Tharp has a very good objective measure of a passing grade. Passing grade in trading is less than 1 mistake in 20 trades. And an excellent grade in trading is making very infrequent mistakes. So obviously this is easy with an easy system. Like if you're doing some, swing trading momentum stock system, which doesn't even use stops, this would be a really easy thing to do. But trading a system on 2-minute charts, which has a trend following and a mean reversion system and not making any mistakes, no, that's not easy, man. It's not easy at all. And many of you might be expert traders and still not capable of doing this right now. And this was my situation. This still is my situation to a certain extent. And if you can't match my trades, then you should book a call with me to explore working together in the Professional Trader Incubator program. Like if you can't get to that point where you're not garbage in, garbage out, then there's no point. And that's the starting point for improvement. So what is the Professional Trader Incubator program? It's a 6-month course, and it will transform you from the trader that you are now into the trader that can effortlessly trade this system for big money. So this is the Euro US dollar equity curve, and you can see it probably looks a lot different than any equity curve I had before anyway. It's steady and smooth. And being consistent and steady and smooth, this is going to make a huge difference to your life. Having black and white rules so that you have no decision to make other than follow the rules. Your decisions are very simple. What do the rules say? That all of your problems in life, in trading, if you're trading right now discretionarily, you have all these problems. What time frame do I look at? What if the 60 minutes shows something and the daily chart shows something? Which stock do I choose? Do I short? Do I long? You've got all these. Where do I take profits? Do I trail a stop or use a target? You've got all these problems. And when you trade with a mechanical system, all those problems are removed and replaced with one problem. You've only got one thing to do: follow your fucking rules. That's it. And so it simplifies life to a large degree. Now, there's an inherent problem with learning to trade any system. And there's an excellent book on the problem called The Dip by Seth Godin. And if we imagine here is your effort, and here's your results. When you first start learning the system, if you first got the Holy Grail presentation or documentation, you went from 0 to 20% pretty quick. Like you learn it really quick, and you thought, this is great. I'm going to implement this really, really soon. And then you hit the dip. The dip is where you're still putting in a lot of effort, but you're actually getting worse. Like all of a sudden you're noticing your mistakes. You're not able to do it with precision. You're noticing new mistakes all the time. You suck. Like you started off here, you went up for a while, and then about a month in, you're going to start to hit the dip, and you're going to feel like you're getting worse. You're going to be, it's going to feel like you're getting worse because you're noticing more and more problems. Your results aren't matching mine. You're starting to think there's something wrong with you or something wrong with the system, and you're tempted to give up. Now, this is where most people give up in the dip. But look at what happens. Once you reach the dip, once you climb out of that dip, you have steady and smooth acceleration in your results. So this dip is something that you have to be both consciously aware of, emotionally prepared for, and just ready to suck it up and power through. You need to summon the motivation to power through. Now, most people stall out at the dip, and that's okay because most people are going to stall out, full stop, in anything to do with trading. You have to ask yourself, do I want to be the guy that stalls out, or do I want to be the guy that sticks with it and gets to the results? So all the really cool things I've learned in my life, most people stalled out at the dip. So I became a Kung Fu Sifu, so my teacher certified me as knowing everything that he knows, and that happened for me after about 12 years of training. But really the dip was the first 2 years when I was getting punched in the face every day, when I was black and blue every single day, and I didn't want to come. And I later learned Brazilian Jiu-Jitsu, And my first 6 months of Brazilian Jiu-Jitsu were just the most awful experience you can possibly imagine. I was a legitimate expert at stand-up fighting, and I'd had over 100 real-world fights, and I was some sort of a badass, and I got put on the ground in a wrestling context, and everyone beat me. The girls beat me, the nerdy-looking accountants beat me, the high school kids beat me, the fat overweight guys beat me. Everyone kicked the shit out of me for the first 6 months of Brazilian Jiu-Jitsu, but I stuck through the dip. So when I learned to trade, I lost money like losing money was the goal until I started to trade systematically. And even then, there was a huge learning curve. And another thing that I've learned, it's not relevant, but I learned to paraglide. So and this was an absolutely terrifying thing. And I used to live in the country in Australia, and I would jump off the hill in front of my house and fly around for 4 hours in the afternoon most days, and then and I would watch the sunset from 1,000 feet up in the sky, and then land on my front lawn as the sun was coming down. It was an amazing thing, but the first 6 months weren't amazing. The first 6 months were me taking off in absolute terror and semi-crash landing in trees after about 30 seconds, and then hauling my fat ass up a hill covered in brambles and spikes and thorns for a couple of hours walking for 30 seconds in the air. So almost everything that's worth doing has a dip. Now, absolutely no way that I would have been able to implement this system or any system without Daniel checking my trades every day and kicking my ass into shape. I was only able to achieve that less than one mistake in 20 trades for the first time in 2014 when Daniel was checking my stuff every day and holding me accountable. And that was key. Holding me accountable, holding me back when I wanted to jump ahead, stopping me from changing the rules. Everyone wants to change the rules. I bet you've already seen this stuff, and all of you in your heads are already thinking, I could do better than that. I want to change the rules. But what you want to do is hold back on that. You can change the rules later, man. So I can do that for you. I can help you with that. So no matter how good you are, and in fact, the better you are, experts need help too. Usain Bolt has a sprinting coach. The best MMA fighters in the world have coaches. Everyone who's the best chess players in the world have coaches. I'm a pretty decent trader by most metrics. I'm not the best in the world, but I'm definitely a professional trader. And it took me 3 whole months to get this running adequately on ES futures. And I'm 2 months into Euro USD, and I'm still a month away from trading adequately. And that's just the reality of it. This is not going to happen overnight for you, and I don't want to pretend that it will. So what do you want? Everyone wants comforting lies. I've got unpleasant truths for you. The unpleasant truth is this is going to take a minimum of 3 months of hard work, and I mean near full-time work, or 6 months of part-time work. That's the truth. So if you want my help, how does it work? So we cannot take just anyone who's got the money on this course. It doesn't work for us. So we have an incredible record with our private mentor students so far. We haven't had a loser among them. And we only get that by only taking people that we are certain are going to be successful traders. And so we stack the decks. I have to work privately with someone for 6 months. I'm not taking dickheads. I like to take smart people who aren't fantasy thinking, get rich quick guys. I'm looking for serious people who are ready to work. I can show you how, but I can't do the work for you. So how much does it cost? The cost is 2 parts. The big commitment is the time commitment, and the financial commitment is there as well. So the time commitment starts out at about 3 to 5 hours per week, starts out slow, and increases to 10 hours per week towards the end of the 26-week course. So it's a half-year course, 6-month course, and the financial commitment is $200 per week over the 26-week course. And some of you are probably thinking, I don't want to spend that much. And you probably don't want to spend that much, but my question to you is, how much do you plan on making from trading? Are you planning on making more than $200 a week? Because I sure am. I wouldn't do this for $200 a week. I don't think anyone would. I think anyone would do it ultimately if the end goal wasn't less than $2,000 per week. So I want you to have a think about your worst trade this year. Like, what was just the worst trade this year, and how much did that cost you? And not just the money, but what I remember about all my worst trades is how much they sucked. I remember staying up to 2 a.m. to watching a trade with no stop loss on, which eventually I had to, at 4 a.m, I had to, had to kill the trade anyway after it lost much more than I planned to lose. And what would it be worth to never ever do that ever again in your life? And I will never do that again. I can say that with certainty. So this program is going to transform you. So at the end of the course, you'll keep track of the system performance every day for 6 months. And that's kept track of the system performance at the times per day that you are going to be sitting at the screen in an identical situation to what you're planning to do in your new job from now on. You will have completed a massive backtest. I mean, 1,500 plus trades. Some people are automating, some people are doing it manually. I can see the wisdom in automating it, but I have a strong preference to doing things manually, even though it takes a lot more time. And there's reasons for that. And you will have traded 300 plus real money live trades with me checking every one. And you will be every bit as good as Daniel and I. And, we're not wizards. We're just average at this. We're adequate, and we have an objective measure of adequate. At the end of the course, you will have kept track of the system performance every day for 6 months. You'll have completed a massive backtest. You will have traded 300 plus real world trades. And I'd like to help you say goodbye to learning to trade forever. It'd be nice to just settle in, trade the one system for years and years and just grind out some money. Because most of us, by the time we get to this situation of wanting to trade systematically, we've been doing this for years. Like by the time I started trading systematically, I was 4 years deep of like 18-hour days, and there was a whole lot of pain, and I wanted to put it all behind me. So if this sounds like something that you'd like to do, then book a call with me. And the URL is scalpierstrading.com/HG-rules. You can see the rules there, and you can book a call with me. Or you can do the 5-day challenge first, which I suggest everyone do, and then book a call. So I'm going to take some more questions. All right. What's an example of a double top hammer candle? Let me Black Arbs, what's your question there? What's the example of a double top hammer candle?
Yeah, when I asked that original question about how long should an order remain open for the hammer candle or shooting star candle within a trend, and you said only one bar except for when there's a double top.
Oh, okay, gotcha. A double top is where the high, you've got a hammer candle, and the following bar is equal to the high of that hammer candle without breaking the high of the hammer candle.
Got it.
Okay.
All right, thank you.
Chris, I'm unmuted. Chris, I've unmuted you, so go ahead, man. Any questions?
Yeah, can you hear me?
I can.
Hey, Scott.
Hey,
so quick question around, so your whole system, you traded from 2 a.m. to 8 a.m.
Which is roughly
right? So the European session almost.
Daniel's also started tracking it in the New York session now. So that's roughly an hour before the European Open.
Right. So all your tests and all your results and everything are based around that 6-hour trading window, right?
My personal yes. Daniel's are based around 9 a.m. till 4 p.m. Which is, so Daniel's results are all based around the following window. Now there's some distortions in the market around the New York Open, of course.
Yeah.
Right. So so we're gathering, and there, I suspect and strongly suspect there's significant time of day edges around that. Things get quiet around lunchtime and they get good in the afternoon, and the Open is a bit higher volatility. So we are, we've only got 540 or something real world trades on ES yet. So I'm loath to draw conclusions until we have a statistically significant sample of data. Otherwise, I could easily look stupid and say, "Oh, the Open's an edge," or "the Open isn't an edge," and I could look very stupid. So I think there's going to be distortions in the New York session around the Open, but I'm not 100% sure.
So if we wanted to achieve the same expectancy and R values that you are, we would have to trade that exact same window, right, to match you?
Well, not necessarily. I've shared my results. They're all timestamped, so you could pull out any timestamp, any sub timestamp of that, and
Right.
copy and paste them into a new spreadsheet and do a new equity curve, and wouldn't be that hard to do, right?
Yeah. Okay. To see, yeah, exactly which time frames
Yeah,
actually
and
should match. Yeah. Yeah.
I've got a student who's automating it, who's doing stuff like that now, and it's I suspect there's going to be interesting stuff, but this is early days. We're in month, what is it, month 5 of the system. It's still early days. We're still gathering a statistically significant quantity of data. It looks great for now. Like I'm highly confident in it, but I don't want to lie to you guys. I don't want to pretend it's something it's not. It's a system with 5 months of track record and big back tests. And so far, so good. Number of people are trading it successfully. So far, so good. That's all I can say.
Cool.
Is Euro USD futures liquid enough to trade the system? Whittle, excellent question, man. And let me answer it. So this week, I've started tracking the differences between the differences between 6E and 6E and Euro futures. So so far this week, there's only been 2 differences between a setup, and they'll both wash. So once there was on 6E, not on Euro USD, and once there was a setup that wasn't a shooting star on 6E. So there is significant differences, but so far it's about the same with small differences. And 6E is definitely liquid enough to trade. But I will say that futures have a huge advantage over FX in that commissions and brokerage take a huge chunk out of your FX profits. They're going to take 20% plus, maybe even 25 if you're with a crappy broker. Brokerage it's going to be almost insignificant with futures. So I think, and I've just started tracking it this week, but I think that Euro futures are going to be the way to go. But I need more data. Okay, and 6E is great. And has Daniel switched to FX or still on MES? He's doing MES and 6E. So he's expanded his work. And is he asking which session generated that Euro USD equity curve? It's the European session. Okay. How many trades would you have to complete to have to statistically have a similar expectancy? Richard, your expectancy is based on your average trade. So you can generate an expectancy. Actually, let me show you something. No, I haven't got that in my spreadsheet. So, Richard, I'll send you an email with a 20 trade rolling expectancy. So a good way to measure how a system is going at any one time is to plot how the average expectancy is over a 20 trade rolling window, and you can get an idea of how it goes. So does the system work on commodity futures? It's being tested on gold and crude as well, and so far tests well. Gold tests quite well. Okay, any other questions? No other questions? All right, guys, that's an hour, so we're just about done. So I'm going to wrap it up. I'm going to send everyone the recording. I'm assuming you all want that. And sure, there's no more questions before we're good. The edge after cost on Euro USD is about 0.3 expectancy on. That is highly broker dependent. And if you're in one of those scam brokers, you might need to change brokers. Scam brokers are no good for scalping. All right, guys, I will start sending the 5-day challenge emails on Monday, and I'd encourage you to all do that and see how close to matching me that you are. If you're matching me, then the next step is very obvious. If you can recognize every trade, then you need to do a back test. And then, quite obviously, you need to develop the skill to be able to execute this in real time. So you have two more big projects. Each project is going to take you at least a month, probably 2 months each. You know, if you can't match the system, then you're nowhere. Like, you're still in the dip. You know, you have to get past the dip, and the dip is being able to match my trades. If you need help with that, I would be delighted to help you get through that dip and through the next bits much quicker than you can do on your own. So, okay, guys, I'll post the recording later today. Thanks, guys.